How is it that billion-dollar firms are paying zero tax on crypto trades that would cost you 37%? It's a question that should keep every crypto investor up at night because the system feels rigged, and honestly, in a lot of ways, it is. The old Crypto Tax Playbook was written by lawyers for the super rich. It's designed to keep you confused, overwhelmed, and ultimately overpaying. They want you to think this is all a taxable nightmare you can't possibly get right. They want you to believe the only safe move is to just hand over a massive slice of your hard won gains to the IRS for peace of mind. They've built a maze of jargon, filled it with terrifying forms like the 8949 and Schedule D, and they constantly whisper about audits and penalties. The fear is the product. Their goal is to make you so afraid of making a mistake that you won't even try to legally minimize your tax bill. It's a brilliant strategy for them. It keeps accountants rich and the IRS well funded, all at your expense. Well, today we're tearing up that playbook. We're taking that 1,000-page manual of confusion and lighting it on fire. The truth is, the core principles the wealthy use to slash their tax bills aren't that complicated. They've just been wrapped in layers of expensive legal advice to keep them out of your hands. I'm going to give you a new simple framework, a new playbook written for the regular investor. It's built on three clear plays anyone can use. This isn't about shady loopholes or illegal tax evasion. This is about understanding the rules of the US tax system and making them work for you, just like the pros do. By the end of this, you won't just understand crypto taxes, you'll have a clear strategy to legally lower your bill and keep more of the money you earned. Before we get to the new plays, we have to understand what we're up against. Let's dissect the old playbook that's been causing so much confusion. The heart of the old playbook is complexity as a weapon. The IRS officially classifies crypto not as currency, like the dollar, but as property. This one decision is the root of all evil in crypto taxes. Think about it. If you trade a dollar bill for 4 quarters, you don't have a taxable event. But because crypto is property, if you trade $100 of Bitcoin for $100 of Ethereum, the IRS says you just sold your Bitcoin. That sale is a taxable event. You have to calculate your gain or loss on that Bitcoin from the moment you got it to the moment you traded it. Now imagine doing that hundreds or even thousands of times. Bought a coffee with crypto, that's a sale and a taxable event. Swap some Solana for an NFT, a sale of your Solana, taxable event. Earned staking rewards, that's income. And when you sell those rewards later, that's another separate taxable event. Every single click becomes a line item on a tax form. This creates a record-keeping nightmare. The old playbook demands you know the exact US dollar value of your crypto when you acquired it, your cost basis, and when you sold, swapped, or spent it for every single transaction. For an active trader, this is an impossible standard for a human to maintain, and that's by design. It's so overwhelming that you either pay an accountant thousands of dollars or you just throw your hands up and pay more tax than you actually owe. The second part of this old playbook is fear as a motivator. We're constantly told the IRS is cracking down. They've got blockchain analysis tools from firms like Chainalysis, and they're sending out warning letters. And yes, a new wave of regulations is coming. Starting with transactions in 2025, which get reported in early 2026, exchanges will begin issuing a new form, the 1099-DA, to report your crypto sales directly to the IRS. The message is clear. We are watching, and if you mess up, the penalties will be severe. We hear about fines up to 75% of what you underpaid, plus interest, and even criminal charges in serious cases. This fear paralyzes investors. Instead of strategically planning throughout the year, they wait until April, dump a chaotic mess of transaction logs on an accountant's desk, and just hope for the best. This is a losing strategy that guarantees you'll pay the highest possible tax. The old playbook shouts about the 10% to 37% tax rate on short-term gains, but stays real quiet about how to use your losses. It treats losses as an afterthought, but we're not playing defense anymore. It's time to go on offense. Before we get to the new plays, we have to understand what we're up against. Let's dissect the old playbook that's been causing so much confusion. The heart of the old playbook is complexity as a weapon. The IRS officially classifies crypto not as currency like the dollar, but as property. This one decision is the root of all evil in crypto taxes. Think about it. If you trade a dollar bill for 4 quarters, you don't have a taxable event. But because crypto is property, if you trade $100 of Bitcoin for $100 of Ethereum, the IRS says you just sold your Bitcoin. That sale is a taxable event. You have to calculate your gain or loss on that Bitcoin from the moment you got it to the moment you traded it. Now imagine doing that hundreds or even thousands of times. Bought a coffee with crypto, that's a sale and a taxable event. Swapped some Solana for an NFT, a sale of your Solana, taxable event. Earned staking rewards, that's income. And when you sell those rewards later, that's another separate taxable event. Every single click becomes a line item on a tax form. This creates a record keeping nightmare. The old playbook demands you know the exact US dollar value of your crypto when you acquired it, your cost basis, and when you sold, swapped, or spent it for every single transaction. For an active trader, this is an impossible standard for a human to maintain, and that's by design. It's so overwhelming that you either pay an accountant thousands of dollars or you just throw your hands up and pay more tax than you actually owe. The second part of this old playbook is fear as a motivator. We're constantly told the IRS is cracking down. They've got blockchain analysis tools from firms like Chainalysis, and they're sending out warning letters. And yes, a new wave of regulations is coming. Starting with transactions in 2025, which get reported in early 2026, exchanges will begin issuing a new form, the 1099-DA, to report your crypto sales directly to the IRS. The message is clear. We are watching, and if you mess up, the penalties will be severe. We hear about fines up to 75% of what you underpaid, plus interest and even criminal charges in serious cases. This fear paralyzes investors. Instead of strategically planning throughout the year, they wait until April, dump a chaotic mess of transaction logs on an accountant's desk, and just hope for the best. This is a losing strategy that guarantees you'll pay the highest possible tax. The old playbook shouts about the 10% to 37% tax rate on short-term gains, but stays real quiet about how to use your losses. It treats losses as an afterthought. But we're not playing defense anymore. It's time to go on offense. The new playbook is about a fundamental mindset shift. It's about simplifying the chaos into a clear three-part strategy. These are the three core plays that will be the foundation of your new approach to crypto taxes. Play number one, the income versus investment mindset. You're going to separate the crypto you earn from the crypto you buy. They're taxed completely differently, and confusing them is an expensive mistake. Play number two, the strategic harvesting engine. You will learn to see your losses not as failures, but as valuable assets. We're going to build a system to actively harvest losses to legally wipe out your taxable gains. Play number three, the tax-free fortress. You'll discover how to move your investments into a financial fortress where they can grow and compound 100% tax-free for life. Master these three plays, and you stop being a victim of the tax code and start being the architect of your financial future. Let's break down the first play. Section 3, play number 1, the income versus investment mindset. This is the most critical distinction in all of crypto taxes, and it's where most people get crushed. You have to stop thinking of crypto as one thing. From a tax perspective, it falls into two different universes: crypto you earn and crypto you buy. Let's start with earned crypto. This is any crypto you get, not because you bought it, but because you did something. This includes staking rewards. You lock up coins to support a network and get new coins back. Mining rewards. You run hardware to validate transactions and are paid in new coins. Play to earn gaming. You play a game and earn tokens as a reward. Airdrops. A project sends you free tokens. Getting paid for work. Someone pays you for your services in crypto. The IRS sees all of this as ordinary income. This is the worst kind of income from a tax perspective, treated the same as your salary. It's taxed at your highest marginal tax bracket, up to 37%. But wait, it gets worse. If the IRS decides you're earning this crypto as part of a business and they're getting more aggressive on this, you don't just owe income tax, you also owe self-employment tax. This covers Social Security and Medicare, and it's a flat 15.3% right on top of your income tax. Let's imagine you're a dedicated staker running a validator node and you earn $50,000 worth of crypto rewards. The IRS might see a small business. Depending on your total income and filing status, your tax situation could get ugly fast. First, you could face that 15.3% self-employment tax, $7,650. Then you owe regular income tax on that amount. If you're in the 24% bracket, that's another $12,000. Your total tax bill on that $50,000 could approach $20,000, a nearly 40% effective rate before you've even sold a single token. And here's the kicker. That tax is based on the crypto's fair market value on the day you received it. If you got one ETH when it was worth $4,000, you owe income tax on $4,000, even if ETH crashes to $1,000 a week later and you never sold. This is how people end up with huge tax bills they can't pay. Now, let's compare that to invested crypto. This is the crypto you buy with your own post-tax money on an exchange like Coinbase or Kraken. This is a capital asset. You're an investor, not an earner. With invested crypto, you pay zero tax until you sell or spend it. Hold it for 10 years, no tax. When you finally sell, you pay capital gains tax. There are two kinds. Short term, you sell after holding for 1 year or less. The tax rate is the same as your ordinary income rate. Avoid this if you can. Long term, this is the goal. You sell an asset after holding it for more than 1 year. The rates are much lower, 0%, 15%, or 20%. For 2025, if your total taxable income is below about $48,350 as a single filer, your long-term capital gains rate is 0%. Yes, zero. For most people, though, the rate is 15%. Look at that difference. Earned crypto could cost you 40% or more instantly. Invested crypto held long term could cost you 15% or even nothing. This is why you must separate these two worlds. Our second play turns the pain of a losing investment into your most powerful tax saving tool. It's called tax loss harvesting, and thanks to a special quirk in the rules, it's a superpower for crypto investors. The concept is simple. When you sell an investment for less than you paid, you have a capital loss. The IRS lets you use those losses to cancel out your capital gains. For every dollar of loss you harvest, you wipe out a dollar of gain. Let's say you sold some Bitcoin and have a $20,000 long-term capital gain. At a 15% tax rate, that's a $3,000 tax bill. But you also own some altcoin. We'll call it Degen coin. That's way down. You put in $25,000 and now it's worth $5,000. That's a $20,000 paper loss. Under the old playbook, you just let it sit there. Under the new playbook, you sell it and realize that $20,000 capital loss. Now, you apply that $20,000 loss against your $20,000 Bitcoin gain. Your net gain is now zero. Your $3,000 tax bill, gone, legally wiped from existence. What if your losses are bigger than your gains? Even better. Say you have $50,000 in losses and only $10,000 in gains. You wipe out the $10,000 gain. You can then use another $3,000 of your remaining loss to deduct against your ordinary income, like your job salary. The leftover $37,000 in losses, you carry that forward to use in future years. It's a gift that keeps on giving. Here's the superpower part. For stocks, this is limited by the wash sale rule, which says you can't claim a loss if you buy back the same stock within 30 days. But as of right now, the IRS classifies crypto as property, not a security. So the wash sale rule does not apply. This is a critical loophole the government itself acknowledges. You could sell your Degen coin, book that $20,000 loss for your taxes, and, if you still believe in the project, buy it back 5 minutes later. You get the tax savings and you keep your position. A major heads up, this loophole will not last forever. The government has made it clear they intend to close it. It is very likely that in the next few years, the wash sale rule will apply to crypto. But for now, it's a perfectly legal and powerful strategy. You should be scanning your portfolio at the end of every quarter and especially year end looking for losses to harvest. Don't leave them on the table. All right, we've covered the core mindset shift and how to turn losses into wins. If you're finding this valuable and want to stay ahead of the curve on taxes and crypto investment strategy, I highly recommend joining my free weekly newsletter. It's where I share insights that don't always fit into a full video. The link is in the description. Subscribers get first access and discounts on my masterclasses covering these topics in even greater depth. It's the best way to stay informed as these rules change. This final play is the ultimate long-term strategy. This is how you build a financial fortress where your crypto can grow for decades, completely untouched by the IRS. I'm talking about a self-directed Roth IRA. A quick recap on Roth IRAs: you contribute money you've already paid taxes on. For 2025, the limit is generally $7,000 a year, or $8,000 if you're age 50 or older. The magic is that once the money is inside, all investment growth is 100% tax-free. When you take it out in retirement after age 59 and a half, your withdrawals are also 100% tax-free. No capital gains tax, ever. Imagine you invest $5,000 in Bitcoin in a regular taxable account. It explodes over 20 years to $250,000. When you sell, you have a $245,000 capital gain. At 15%, you're writing a check to the IRS for over $36,000. Now, what if you made that same $5,000 investment inside a Roth IRA? It grows to the same $250,000. In retirement, you withdraw it all. Your tax bill is zero. You keep the entire $250,000. That $36,000 is the power of the fortress. Here's the catch. You can't just go to a standard broker like Fidelity and buy actual Bitcoin in your Roth IRA. That's where the self-directed part comes in. A self-directed IRA (SDIRA) lets you invest in alternative assets, including real crypto. You open an account with a specialized custodian that supports crypto IRAs. They give you checkbook control to direct your own investments, letting you buy real crypto and hold it securely. Once you're set up, the game changes. That nightmare of tracking taxable events, it disappears inside the IRA. You can swap Bitcoin for Ethereum, trade NFTs, experiment with altcoins. None of it is a taxable event. All growth is sheltered, compounding year after year, tax-free. Be aware, however, that these custodians have their own rules. Some may limit trading frequency or the types of assets you can hold, so do your homework. This is the ultimate strategy for long-term believers. But there are rules. High income earners are phased out from contributing directly. If that's you, you'll want to look into a strategy called the backdoor Roth IRA. And you can't just move existing crypto into an IRA. You have to contribute cash and then buy the crypto inside the account. For the self-employed, an even more powerful tool is the Solo 401k, which allows much higher contributions and can also be self-directed into crypto. The old playbook wanted you confused and scared. It profited from chaos. We've torn it up. Our new playbook is simple and powerful. First, you adopted the income versus investment mindset. You know the difference between high tax earned crypto and lower tax invested crypto. No more surprise tax bills. Second, you've built a strategic harvesting engine. Losses are now valuable tax assets you can use to legally erase your gains, especially while the wash sale loophole for crypto remains open. And third, you've discovered the tax-free fortress. You know how a self-directed Roth IRA can shield your investments from capital gains tax, letting them compound for decades protected from the IRS. This is your path forward. The rules are still complex, and with new 1099-DA forms coming, the IRS will have more visibility than ever, but that shouldn't scare you. It should motivate you to be smart. You need a plan, and now you have one. This is not official tax advice. I am not your CPA. You have to consult a qualified professional for your specific situation. But this is your new playbook. It's designed to empower you to ask the right questions and take control. The wealthy have used these principles for generations. It's time we brought that power to the regular crypto investor. Don't just watch this. Implement it. Start separating your transactions, look for losses to harvest, research a self-directed IRA. The only thing worse than paying too much in taxes is doing it willingly because nobody ever gave you the playbook to win. Now you have it. Go use it.